Let me show you the most sophisticated money loop in modern history.
The AI market is now a bubble, and even insiders are admitting it. Nvidia is investing in its own customers, who in turn purchase more of the firm's chips. Meanwhile, AMD is offering OpenAI partial ownership in a chip purchase deal. This web of circular investments and deals is fueling a rapid rise in stock prices. At the centre is OpenAI, which has organised over $1 trillion in computing deals.
It is hiding in plain sight, dressed up in words like innovation and infrastructure, and it involves some of the most powerful companies on the planet, passing the same pile of money back and forth to each other in a circle. OpenAI signs a $300 billion deal with Oracle. Oracle immediately buys tens of billions in GPU chips from Nvidia. Nvidia turns around and invests $100 billion back into OpenAI. Microsoft funds OpenAI through Azure while also being its largest investor. Then OpenAI uses that money to buy chips from AMD, becoming one of AMD's biggest shareholders. The money goes in a circle. The headlines amplify each deal. The stock prices climb in lockstep. And everyone tells you it is a revolution. But what if it is not a revolution? What if the so-called AI boom is actually functioning like the most well-dressed Ponzi scheme in economic history? That is roughly the combined GDP of Japan and Germany. Sam Altman, the CEO of OpenAI itself, publicly stated in 2025 that he believes an AI bubble is ongoing and that investors are overexcited. Ray Dalio, the co-chief investment officer of Bridgewater Associates, one of the largest hedge funds ever created, said the current level of AI investment looks very similar to the dot-com bubble. Jamie Dimon, the head of JP Morgan, the largest bank in the United States, warned that a lot of the money being invested right now is going to be wasted. Google's own CEO, Sundar Pichai, admitted there are elements of irrationality in the AI market and said no company, including Google, would be immune if the bubble burst. So the architects of this boom are telling you it is a bubble, and yet the spending keeps accelerating. The four biggest hyperscalers, Amazon, Google, Microsoft and Meta, spent over $350 billion on AI capital expenditures in 2025 alone. McKinsey estimates that global data center infrastructure spending will hit $7 trillion by 2030. And here is the part that should make your stomach drop. A Bain & Company report found that the AI build-out will need $2 trillion in annual revenue just to sustain its growth. $2 trillion per year.
A recent report found that AI companies will need $2 trillion of annual revenue to fund the infrastructure needed to meet projected demand for AI by 2030. This is an $800 billion shortfall.
For context, American consumers currently spend about $12 billion a year on AI services. That is roughly the GDP of Somalia. Read that again. The industry needs the economic output of a top 10 global economy to justify its existence. What it has is the economic output of one of the poorest nations on Earth. If you can understand the distance between those two numbers, you understand why analysts are panicking.
A lot of analysts are beginning to express concerns that OpenAI could become a single point of failure within this AI ecosystem, especially from an infrastructure standpoint. The scale of the deals is undeniable, and it's going to be a question on if they can deliver what they have promised. It's kind of this circular flow of money that some analysts think is a little unnerving and reminiscent of, the dot-com bubble where we saw vendor financing really come to a head.
Now here is where it gets truly disturbing. Let us talk about the mechanism. A classic Ponzi scheme uses money from new investors to pay returns to old investors, creating an illusion of profitability until the new money stops flowing. The AI industry has built a more sophisticated version of this. Nvidia invests in companies. Those companies use the investment to buy Nvidia's chips. Nvidia's revenue spikes. Nvidia's stock price climbs. More investors flood in. The cycle repeats. This is vendor financing at a scale that makes the dot-com era look like a lemonade stand. The last time we saw circular financing this aggressive was with Lucent Technologies in the late 1990s, a company that lent billions to its own customers to keep chip orders flowing. When the bubble popped, Lucent nearly went bankrupt, wiped out its investors, and had to be sold at a fraction of its peak value. Michael Burry, the legendary investor who predicted the 2008 housing crash and was portrayed in The Big Short, is now actively betting against Nvidia. He is on record saying that true end-user demand is ridiculously small and that almost all AI customers are being funded by their own dealers. Jim Chanos, the short seller who predicted Enron's collapse, drew direct parallels between Nvidia's strategy and the accounting tricks that destroyed Lucent. And the numbers support their skepticism. An MIT Media Lab study found that despite $30 to $40 billion in enterprise investment in generative AI, 95% of organizations are getting zero measurable return. Not modest returns, not disappointing returns, zero. But the Ponzi comparison gets even more uncomfortable when you examine how this build-out is actually being financed. It is not just corporate cash and equity investment, it is debt, a staggering amount of debt. Morgan Stanley estimated that debt used to fund data centers could exceed $1 trillion by 2028. The top 5 hyperscalers alone raised a record $108 billion in debt in 2025, which is more than 3 times the average over the previous 9 years. Meta has raised $62 billion in debt since 2022, with nearly half of that issued in just 2025. And they are using tricks straight from the 2008 financial crisis playbook. Companies are creating special purpose vehicles to keep debt off their balance sheets, the same financial structures that were central to Enron's collapse. Data centers are being rolled over from construction loans into asset-backed securities where investors pick tranches based on risk. Sound familiar? It should. This is the same securitization logic that built and destroyed the subprime mortgage market. OpenAI alone has committed to spending $1.4 trillion on data centers over the next 8 years, despite projecting annual losses through 2028, including $74 billion in operating losses in 2028 alone. Deutsche Bank estimated OpenAI's total losses between 2024 and 2029 will reach $140 billion. A former Fidelity manager calculated that OpenAI is burning $15 million per day on its video tool, Sora, alone. And yet, OpenAI's valuation tripled in a single year, from $157 billion to $500 billion. That math only works in a world where the music never stops. Here is why you should care, even if you do not own a single share of Nvidia stock. By late 2025, the 5 largest AI-driven companies made up 30% of the entire S&P 500 and 20% of the global MSCI World Index. That is the greatest market concentration in half a century. AI-related companies accounted for roughly 80% of all stock market gains in 2025. Deutsche Bank's head of FX research warned his clients that if you strip out AI-related investment, the United States had GDP growth of just 0.1% in the first half of 2025. That means if the AI bubble pops, the American economy is functionally in recession. Your 401k, your pension, your index fund, they are all deeply exposed to this one single bet. Julianne Garin of Macro Strategy Partnership published a report calling this the biggest and most dangerous bubble the world has ever seen, estimating it is 17 times larger than the dot-com bubble and 4 times larger than the 2008 housing crisis. And the dot-com crash wiped out nearly 80% of the Nasdaq's value. The people on the inside know this. Peter Thiel sold his entire stake in Nvidia. SoftBank dumped nearly $6 billion in Nvidia shares. Deutsche Bank is actively shorting AI stocks. These are not panicking amateurs. They are professional money managers heading for the exits while telling the public to stay calm. Look, nobody is saying artificial intelligence is not real technology. The internet was real technology too, and the dot-com bubble still destroyed trillions of dollars in wealth. The railroads were real technology, and the railway bubble still bankrupted thousands of investors. AI will probably change the world, but the financial machine currently built around it has every hallmark of a bubble that could take the entire economy down with it when it corrects. The circular deals, the vendor financing, the off-balance sheet debt, the securitization of rapidly depreciating assets, the extraordinary market concentration, the sky-high valuations disconnected from actual revenue. Every single red flag from every previous financial disaster is waving at the same time. So here is the question I want you to answer in the comments. If the CEOs building the AI boom are themselves admitting it is a bubble, why is no one pumping the brakes? And more importantly, is your money protected if this thing collapses? Drop your answer below. And if this video opened your eyes, share it with someone who needs to hear this before it is too late. At Machine Minds, your opinion matters to us, so please feel free to like, subscribe, and share your thoughts in the comments section below.